The Hedgeless Horseman here. It's May the 5th, 2025. I haven't done a video in a while. There's a few reasons for that. Obviously sentiment has been getting better. The average junior has been performing quite well. I mean, some really well over the recent past, and all of a sudden nobody really needs a reason to own slash buy juniors, even though, ironically, and this is never going to change, even though they were in fact cheaper last year. I mean, I think the bottom was in last year, and they've been cheaper a few months ago, I guess. Gold still did well, but some of the juniors and many of the juniors were at a lower price without too much changing. So that's something I think really should become instinctual. Again, just notice the fact that gold hasn't made a new all-time high, but juniors have been doing relatively well recently. Playing a bit of catch up, especially with when silver went to $39, and for some reason silver appears to be more tied to the junior sentiment, even for gold juniors, than the gold price. Obviously, in my opinion, that's why gold juniors, especially last year, were the most obscene risk reward I've ever seen. I mean, if you're value investors, like, if the, let's say, retail driven market is going to price gold juniors based on what silver is doing, and therefore what the sentiment is for silver, I mean, that's just great, especially if silver is done poorly and the sentiment is bad, because that doesn't change the fact that the gold price has been where it has been, meaning, all-time highs. So that was great. I mean, that's, in my opinion, one of the most obvious examples of why this sector is a joke. In short, so much is sentiment driven, and so much of the sentiment is tied to even stuff other than the price of gold for gold juniors. Again, how can you rationally explain that? And then that, of course, people, or I should say, a lot of people see that as a reason for why this sector sucks, because gold went up and the gold juniors haven't really. I mean, they still have a lot of catch up to do, but a lot of people look at that absolute underperformance versus the gold price and see that as a reason why this sector sucks. Of course, the flip side of that is, as again a value investor, if you believe there is such a thing as intrinsic value, and sooner or later that's going to be reflected. I mean, you can't ask for a better setup, basically. That the very thing you're buying in the ground gets priced based on something else, and that's just crazy. But that's how this sector is, and probably always going to be, because again, it's like price and values and afterthought. So I've never had a easier time in a sense to be bullish. I've been long since 2015, but it's like, I mean, I've never seen anything like it, and I would say that yes, many gold juniors are up, but are they, you know, pricing in anywhere close to the current spot gold price? I don't think so. One thing, again, I would just like to point out that silver is seen as the more speculative of the two. Silver tends to lag gold, and then when gold goes, and sooner or later silver kind of gets dragged with it, and that's what we kind of seen. Gold has been kind of consolidating, and silver hit a new 12-year high, and all of a sudden the silver juniors went up quite a bit. I would just again like to point out, I'm not really in the greater fool trading game. At least I don't like to think so. Obviously, I'm gonna benefit from sentiment going higher, even though if value doesn't change. But just the fact that sentiment is going higher, that's gonna affect prices of stuff, and that's gonna affect the portfolio. But that's not my, preferred. Let's say my I don't have a full-on trading sardine strategy where I'm only buying silver juniors, for example, because they're gonna get priced higher because of the masses, and that everybody's kind of when people think about this sector, it was like, what's the attraction really for this sector? It used to be that silver juniors or gold juniors overall are the most some of the most volatile assets around. It's like a lot of people see it as a casino. I mean, if you look at how volatile the prices are, it sure looks like total chaos in a sense that 1 year you'll make a shit ton of money. Next 2 years you'll lose a shit ton of money without not that much happening actually. I mean, some projects might have actually gotten better, but that still doesn't change that they might go down 70%, yada yada yada, and then you get stuck in the maybe dilution spiral or whatever it might be. So it just almost looks random from that sense. That's like the timing and sentiment timing is so. I'm not gonna say so important, but it sure drives prices. I haven't tried to time the market once, and I do fine. So that's, in my opinion, an example. It's like, I mean, a lot of people say you need to get timing right, and yes, I mean, in a sense that's correct, but I don't time anything. I've been fully invested in all in since 2015, and I sure don't time my sales at medium cycle highs, for example. So my portfolio takes huge paper losses now and then, and that still hasn't changed the fact that when it comes back, if you still focus on stock picking, if the portfolio goes down 50%, when it turns, and assuming you're somewhat active in the sense that you at least want to keep the portfolio in the, let's say, cheapest names you find. I mean, 100% rip is nothing really. We've seen stuff do that in 2 weeks or in the last month, even though value hasn't changed that much. But I would note that silver juniors attract the most, let's say, risk on people. That's probably the best way to say. And of course, there's a lot of people that are aware of this, that silver juniors tend to, I was going to say, be the most irrational. Because nobody, or a lot of people that buy, let's say, silver juniors don't really care about the value. They just know that they are the ones that people tend to, or retail tends to, get the most FOMO in and greed in. So there's obviously, as we can see on Twitter, there's a lot of FOMO hype for silver juniors, let's say, and you have several accounts that basically jump in the same silver juniors and gets the crowd going. So I mean, that's why we've seen some immense rallies in some silver juniors. The thing is, gold is still very much above its 2011 high, and I would probably say that gold juniors are still cheaper relative to gold than silver juniors. Most silver juniors are to silver. And let's not forget, I mean, 100 million ounce silver deposit, that's a pretty big silver deposit. But at the current price gold to silver ratio, that's only around 1 million ounces. So I think you can tell that there's much more hype around 100 million ounces of silver than it is around 1 million ounces of gold. Nobody really gives a shit about 1 million ounces of gold, but 100 million ounces of silver, that is, pretty impressive in the silver space. So again, from a value investor standpoint, does that make a lot of sense? There's like, okay, 1 million ounces of gold is worth as much as 100 million ounces of silver, so you should be equally, all else equal, you should be equally optimistic of the value of either the gold or the silver unit. But that's obviously not really the case. And then, I guess what I'm trying to say is that, well, everybody has their own strategy and all that, but just keep in mind that the gold price is, I think it's 90 times the silver price. Gold silver ratio is like 90. So again, you need 90 times the amount of ounces of silver to have the comparable value of an ounce of gold. And of course, when you describe that to people, the obvious response is, well, silver can go a lot higher. Silver can explode to, when gold reaches whatever, $4,000 or $5,000, maybe silver is at $100 then, and all of a sudden, hey, gold silver ratio comes down a lot, and the silver juniors today look very cheap in a $100 silver environment, obviously. But note that that's still speculation, right? Any price, any buy, let's say, that factors in, well, if gold prices go higher and all that, that's still speculation. That's not my preferred way of doing it, even though that's absolutely true that usually silver juniors do better, and silver is in a full-blown bull market, and silver, this price of silver is more volatile, it's lower liquidity, so it can move a lot more. But don't kid yourself, that's still speculation. Call a spade a spade. If you're a strict value investor, you're not really, and we're talking margin of safety and all that, I'm not really speculating on the price of gold and silver. I think both are going to go higher, but I haven't built a portfolio that's like, well, if silver does really well and the silver junior sentiment gets crazy, it's like you're going to make a shit ton of money. Yeah, we've seen that in a lot of rallies. That tends to happen, especially later in the cycle when sentiment gets really hot. But it's also a double-edged sword, which we've seen recently, that when copper crashed recently, silver got kicked in the teeth a bit, not as bad as copper. And a lot of these silver juniors that went up 100% or 50 to 100% on no real change. Yes, silver went from whatever, $37 to $39, but what does that really matter? Silver is already, I think, back to 37.5, for example. So silver enjoyed a $39 gold silver price or a price of 39 for a few days or something. So of course, when you talk about the intrinsic value of a silver junior, how much did that change from silver going from 37 to 39 over a few days and then back again? It's like nothing. Most of them don't even have something in production, and the ones that do might have something in production in like 5 years. So what does it matter really? What's that silver traded to up to 39 for a while instead of 37, and all of a sudden, the silver juniors go up 100%. Did the intrinsic long-term value of the silver juniors go up 100%? Just because silver went from 37 to 39 in July and August of 2025? Of course not. So it's mostly, it's sentiment driven. That's the thing. You see also when the momentum stops, even for a short period, and sentiment is affected, that's hot money getting into stuff, and that's hot money leaving. So I bet you there's a shit ton of people that bought the recent highs in a bunch of hot silver juniors. And the hot silver juniors, a lot of them are now down like 30-40% in the last 1 or 2 weeks. That's a pretty chunky decline. Um, I would, much rather buy them now than when they were just ripping and everybody was celebrating. And of course, the talk is, well, if silver goes to 50, I mean, that's how it always is. So, I mean, my point is like, you live by the sword, you die by the sword. If you know something went up mostly on sentiment, it is not really, super cheap. Uh, yeah, if something went up a lot of in price due to sentiment and momentum, when that turns, it's gonna go down quickly in price. And then when that turns again, it can go up quickly in price and momentum starts again. But it's like, know what game you're playing. That's all I'm gonna say. Because you're gonna have to suck up a lot of volatility, and you don't want to be the ones, which a lot of people are. They buy on the hot momentum after I run up, then it turns, and they bought in because, hey, they just saw a stock go up 50% in 4 days, and obviously they want to, they read and hear people are celebrating, and now they want 50% in 4 days, and all of a sudden it turns, and you're like minus 40 in a week or something. That's obviously going to feel really, really shitty. And you don't want to be one of those. I mean, since I'm 100% invested and believe we might have a multi-year bull market ahead of us, I'm, the only real thing I do is, some occasional value shuffling. Otherwise, hold the rips, buy the dips until some, stuff isn't cheap anymore. Um, I hope you have an idea of what I'm saying. It's like there's no disputing that silver juniors are known to be able to go up a lot in a short period of time, and that attracts a lot of people, and a lot of people that also attracts a lot of people who wants to attract a lot of other people to buy up silver juniors, if you catch my drift. Um, because it's like retail crack in a sense, and a lot of people obviously know it's retail crack, and they like it because it's retail crack. Because yeah, like a trading sardine, they can go up 100% in a week just from sentiment getting better. Not that you had to be right on any fundamentals, or it was the cheapest whatever story around or anything like that. No, it's just that silver attracts a lot of risk takers, a lot of momentum players, and there's not too many silver juniors around. So if you look from cycle bottom to cycle top, some silver juniors will probably be outperforming pretty much every gold junior. And to me, that's okay, because I don't. I have a hard time buying something just because I'm hoping somebody else is gonna uh, pay a much higher price without good reason. Uh, and obviously that becomes very uncomfortable to really talk about that. I mean, if there is, let's say, such a story, or stories, or that's the main point. I mean, I hope I would point that out, because otherwise, yeah, it's just very uncomfortable to highlight stuff that's like, hey, this shouldn't really go up, or it, yeah, it shouldn't really go up. Uh, but buy this, because if silver goes up, yada yada yada. Yeah, no, that's just greater trading, uh, greater food trading scenarios. Anyway, another thing, um, I discussed this with Shadow K Report actually at length. I find it kind of interesting. I mean, I love theory crafting about investing. What is the market missing? What is it getting wrong? What is it ignoring? Yada yada. One thing that has been quite hot over the last few years is that pretty much only a tier 1 discovery has. I mean, lately, yes, lately stuff has been going up uh, overall. But my point is that the juniors that have typically done really well is like tier 1 discoveries. That's about it. Where the market believes there could be tier 1 discoveries. Because I think it still is the case where if you look at what tier 2 and tier 3 assets are selling for, Most of them are selling below sunk costs. I mean, it's like we discussed Wallbridge a bit. It's a Canadian developer. They have a super shitty share structure, like 1.1 billion shares out. Um, it's not a tier 1 deposit. Maybe it's a tier 2 deposit, potentially tier 3. And I don't know exactly how much money they spent on, I think it's Fenelon. But let's say they spent $250 million over 10 years. It's trading for 76 million. Uh, a lot probably, a lot of stuff has happened. I think the resource estimate disappointed years back and yada yada, and now the share structure is like it is. And it's funny. I discussed or some a very sophisticated institutional guy who's not he's relatively new to the mining sector, and he asked me, it's like, what's the big deal about share count? How many shares are outstanding? Why does people care so much about that? Because that has nothing to do with value. And that's 100% true. I mean, that's how I started off. It's just basically in the recent years I've started to appreciate share structure. Not because it makes much sense, but we've seen, tight shares, they have an easier time holding on to gains, etc. And for whatever reason, if there's a large amount of shares outstanding, typically these juniors with the same success, with the same news, have a very, much harder time to trade up and reflect that news. And I don't know why exactly that is. And it doesn't really make sense. And in Australia, I mean, that's the norm basically, that you have a billion shares out. But in Canada, I mean, there's plenty of people who I know that's like their number one focus. How tight is the stock? How many shares are outstanding? Not actually what the value of the projects are, or it's like any other of actual fundamentals. Just that how easy is it to move? How much capital do you need? How much buying does it take to move the stock higher? Which is like an affront to efficient market hypothesis. Obviously, shouldn't matter if the share price is $1 or 1 cent. If the market cap is the same, there should be no real difference. But for some reason it's usually a big difference, and it's just one of those crazy things I actually hate about this sector. That you have to, well, not have to, but it's like that it's such, sometimes at least, such a big difference in price, market cap, and how a stock responds just because of how many shares are outstanding, and how tight the float is. And of course that's also going back to the silver, that silver juniors are hot, and a lot of people know that a lot of retail who don't really know much about the sector, they love silver juniors because they only care about or as most people, everybody wants to get rich and rich quick, and everybody's heard that silver juniors can move the most, and that's why they tend to move a lot when they start moving, because everybody thinks that now it's the time to get rich quick. And if you add a low share count, few shares outstanding, a tight share structure, again it's like you're compounding basically the effect of FOMO. So there's you see it on Twitter now, for example, a lot of accounts focus in on the illiquid silver juniors because they know that if the masses, average risk-taking junior investor who doesn't care much about what they're actually buying, they just go where the momentum and FOMO is. If you have few shares outstanding, yada yada yada, you need less capital to have it go up, and if it goes up, even more people are gonna like it. So it makes sense. I mean, if let's say I had a small portfolio and it's like, forget about, let's say, reputation. Let's say I just want to make the maximum amount of money in the shortest time period, for example. If I have $10,000 or $20,000 portfolio or something, and I had the same follower count I have now, for example. It's like buy some illiquid silver junior. As soon as silver starts to get going and the sentiment goes up, it's like pump the shit out of it. Maybe $2,000 worth of buying is gonna have it up 10%, and 5,000 is gonna have it up 20%. And then it kind of escalates, because all of a sudden a uptrend starts to form, and I start bragging about, look how much this has gone up. It's probably going to go up 10x more, and then people get really greedy, so it's up 100% all of a sudden without nothing actually changing. It's like yeah, sure, silver price went up a bit, but it's the momentum and the sentiment, and momentum changes sentiment, and nothing changes sentiment is price. Price momentum. That is like that's not something me. I much more enjoy doing the fundamental route, and that's actually what I kind of like in a sense for example, First Nordic, because like it's not super tightly held. They have around 280 million shares out, which is not really. I mean, it's not a huge share count, but it's pretty high, and there's a lot of liquidity, meaning there's big volumes. So I don't have an easy time. Let's say I can get somebody to buy First Nordic, and all of a sudden the stock is up 10%. That means I feel I can talk more freely about it, because I don't affect the price that much. I mean, the low. I own some micro cap juniors, and some I might not even have talked about, because it is uncomfortable to what am I gonna do? Let's say even if it's cheap, it's like, oh, it pops 40% on nothing, except for it's like, yeah, somebody agrees that it was cheap, and maybe the last guy in on a given day is like, he has no idea what he's doing, just bought it because it's going up, and let's say I talked about it, so now it's 40% quote more expensive. Even if if it was super cheap first, now it's up 40%. Now it's like semi super cheap. If there's something else that's super cheap instead, I mean, it would make sense to take some money off the table. But that all of a sudden feels very weird. It's like, okay, because then I mean, even if you don't necessarily pump it, but just the fact that you might have made the stock move up, and it's like, if I have a strategy of selling into that, then that's literally pump and dump, and that's no fun. I mean, I enjoy discussing and talking about investing strategies, and more the more followers I get, the more conservative I get. And also, I guess, I mean, since I'm not anonymous, that's probably a big thing as well. I mean, most of the let's say very promotional accounts, for example, they are anonymous. So I mean, I think people would act a bit different if they weren't anonymous in a sense. So, but maybe that's a good thing in a sense, because it makes it a bit harder. It's like I really need to think what I say. I really don't want anybody to lose money, for example. And that goes for the family portfolios and whatnot. That's why I have the HODL folio as the featured portfolio, let's say, on my site. My personal portfolio looks quite a bit different, and especially since I have a few portfolios, and some portfolios can only can't own all different kind of stocks, so the portfolios are super wacky in a sense. I mean, one is for private placements, and that's going to get affected obviously by, let's say, a junior with that I find kind of cheap, but they come out with a placement and it's like full warrant for 3 years. I might not have bought that junior if it wasn't for a placement with 3-year warrants. So that's, where I have the placement, that's going to be full of, placement opportunities, if you know what I mean. So that's going to look super weird, and if you can't replicate that, there's no real point in like talking about it. So it's like the HODL folios, they only have publicly listed companies, no private placements. So that's at least something that anybody can kind of, get inspiration from. So that's the factors that or I should say, yes, the HODL folios, they are long-term focused. Mostly focus on, margin of safety, let's say, and not needing really much trading. Yes, occasional value shuffle, whatever, but it's like I expect the HODL folios, if I came back in 2 years and didn't do anything, I expect the portfolios to have done well. And sure, it might look weird that, some juniors crashed out and some juniors went up 2-3x, and all of a sudden you have 3 juniors making up like 50% of the portfolio. That could happen, but I still think it's going to work out. But it's like no placements, not much trading, for example. It's like, because I can't be buying and selling across like 6 portfolios on any given day. That would be super stressful, and keep track of everything. No, so that's, I think, the best way, I guess, to like, okay, give some maybe inspiration of what some long-term stories, good long-term stories could be. But back to the point, me, I always go on rants. My point about Wallbridge is that tier 2 and tier 3 assets, which are hard to find, especially tier 2 assets, they're very hard to find. And tier 1 assets, forget about it, there's not a lot of them around. And that's why there was an article, or maybe it was a video, but some, market commentators said, the majors might need to start to lower their threshold for, what mines they're going to acquire, and be okay with buying 200,000 ounce producing deposits instead of 500,000 ounce plus, which is today, considered tier 1. Why? Because there's not enough around. And if they are, some of them are, let's say, Snowline, which is a world-class deposit, that might be in production in 10 years, I don't know. But it's still 10 years away. And we're not finding too many of those. And if you look at what tier 2 even are selling for, or tier 3, it's like they're selling below sunk costs. So in that sense, like, when would it make sense to go out and explore for gold? It's like, if let's say Fenelon, for example, and Borsley is the same. It's like, if they're tier 2 deposits, and let's say it cost 200 million to get them to that stage, plus you have to be really, really lucky to even find a tier 2 deposit, and then it's going to take you 5+ years to prove it's a tier 2 deposit, plus all the, dilutions along the way, all the capital raising. If it costs you 200 million and 5 years plus to prove up a tier 2 deposit, and you can, let's say, buy it for half of that today, why would you go out and explore for it? The only time it would be really worth it, meaning it's like you're gonna get more reward in this sector, in this sentiment right now, is if it's like a tier 1 deposit you find, because they are very likely to get bought, because every major is obsessed by tier 1 deposits. Agnico kind of made it a thing, I guess, and they have had great success, where it's like, really fat projects, 500,000 ounces plus, basically regions, what have Detour, Canadian Malartic. They've been making a shit ton of on those mines, like big mines, not 500,000 ounces mines to keep track on. No, they've been betting on huge deposits, and Newmont just sold like 7 to 9, I think, tier 2 or worse mines, producing mines and deposits. They also want to do what Agnico is doing, only stick to tier 1, not have too many projects, but big fat tier 1 projects. And obviously the more of these big guys who are printing massive cash flows, the more they want tier 1 deposits, and the more money they have, the more they can pay for a tier 1 deposit, because that's the only thing they're going to buy. So I mean, a lot of the tier 2, tier 3 deposits are somewhat stranded, and I don't think that makes a lot of sense, because there's not too many tier 1 deposits out there. My point is that if you can buy tier 2 and tier 3 deposits for much less than it costs to find them, and you don't need to wait 5 years to prove that you found it, then you have to have a really good reason to be in an exploration story. And I mean, if you fast forward the tape, I mean, I find this kind of interesting that, okay, let's say most of the tier 2, tier 3 deposits, they're pricing in that they're probably not going to become mines. And if they're going to become mines, they're probably not going to make any money, because whatever, the gold price goes down, etc. So does that make sense? I mean, if we simply don't find many more tier 1 deposits, and all the major mining companies, they eat up 1, 2, 3 million ounces or more of gold per year that they need to replace, right? So let's fast forward 5 years, and there's like 0 tier 1 deposits out there not belonging to a major. And the 10 best deposits out there are tier 2, for example. And time goes by, and no new tier 1 deposit is really found, especially in a jurisdiction that majors are comfortable with. It's like, and they're seeing their reserves deplete because their tier 1 mines are, producing like 500,000 ounces per year. It's like, what do you do then? I mean, even if they're not called tier 1, if the 10 best undeveloped gold projects in the world are considered tier 2, they're still the 10 best gold projects in the world. And I don't think they're pricing in that at all. I mean, yeah, tier 2, tier 3 deposits. So that's honestly one thing I could see as a big theme going forward. And especially the, let's say, the risked and advanced ones. Because even if you found tier 1 deposits very remote, I mean, Donning Creek, for example, is still sitting there, but it is a tier 1 deposit. It's huge, 40 million ounces. But at the same time, it's like, if we start finding tier 1 deposits now, but they're not going to be in production in 10 years, I mean, in 10 years, the major miners will have depleted a lot of their current gold in the ground. So it's like, won't they feel kind of forced to do something if it's like they literally can't get one of those tier 1 deposits up and running within the next 5 to 10 years? Or are they just gonna sit there and it's like, yep, we're shrinking every year basically, and you were just waiting for these tier 1 deposits. Meanwhile, there's some advanced tier 2 deposits, but yeah, right now they're pricing in like, there's never gonna become a mine. No, long-winded rant, but I hope you get my point. It's gonna be interesting to see what happens in a finite sector when maybe the majors and maybe even mid-tiers are kinda too stubborn in a sense. It's like, no, we get burned so bad in 2011 to 2015 that we're only gonna bet on tier 1 deposits, and obviously everybody's looking at Agnico. That's the only thing. Not the only thing, but that's kind of what made them I think there might still be the highest market cap gold company, or maybe Newmont has surpassed them. But anyways, like, their thing was huge deposits, massive scale, make a shit ton of money. Not that they even produce the most amount of ounces, but like high quality stuff, again, just sticking basically to the best of the best. And everybody's seeing that, and that becomes a thing, I guess. And Alamos Gold kind of done the same thing, right, with Island. they're just ramping up the existing mine, whereas I think a lot of other majors might have had a much harder time. But like, just look at Kinross. I mean, they bought Great Bear. What was 2019, 2021, whatever. That's still not in production. It took 500,000 meters of drilling to prove they have like 5-6 million ounces. So it probably cost hundreds of millions of dollars to prove what uh, that they have they have, but it's still not in production. So it's like that's what maybe from discovery, like 10 years until production or something. Maybe they have a quicker timeline than that, but just goes to show, I think, how much investment is needed to prove up the risk and put into production a tier one asset. But yeah, so how are they gonna react? What's gonna happen if you have all the majors and the biggest mid tiers? Everybody's just waiting for these tier one deposits, and we don't find any more. It's like one shows up. There's like whatever 5-6 majors that would want it. Only one can buy it, of course. So what are the other five gonna do? Let's say another one comes up, and okay, that goes to another major again, maybe. So 2 out of 6 have a tier one. But then we're like 5-6 years out, and there's not been any more tier one deposits, and all of those 6 majors have taken ounces out of the ground at a quick pace, and maybe some of the jurisdictions out there in the world gets a bit sketchier. What are you gonna do then? Are you gonna still stick to your stubborn tier one idea because Agnico has done so well implementing that? I mean, I personally think that that's probably a cyclical thing, and maybe flavor of the month. Not that it doesn't make sense, but does it make sense to be that stubborn for all the major mining companies if there simply aren't that any tier one deposits around? So I mean, maybe every major, most majors got so burned from 2011 to 2015 that they're like, we're really not gonna spend. We're really not gonna do a lot of M&A. And then now fast forward, it's like, okay, Agnico. Everybody's watching Agnico rise to become the number one valued gold company. It's like, okay, how did they do it? Well, very selective about their assets, typically, again, very large production, tier one, and they keep cost control. Okay, so now the theme is like, okay, everybody's gonna do what Agnico's gonna do, maybe. I mean, Barrick basically went off the rails and went with copper instead, and who knows how that's gonna play out. Obviously, they don't look too smart relative to Agnico, who bet on gold and are surpassed Barrick. And Barrick even changed their ticker from gold to whatever their new ticker is. But maybe yes, maybe now the thing is everybody went from like, don't make any acquisitions at all really, to follow Agnico, and if you're gonna do acquisitions, just do tier one acquisitions. And we've seen again Newmont shed all their tier two to tier three assets, so they're going the Agnico way, kinda. But again, if everybody piles into that strategy, and we don't find any more tier one deposits, what are they gonna do then? I hope you get what I'm saying. It's like, it's gonna be interesting to see if this also, in a sense, backfires, and if it does, and all of a sudden there's a scramble. It's like, holy shit. There's no tier one deposits around. Gold is, just keeps on going. We're minting cash. We wish there was tier one deposits out there to buy, but we can't. And if one shows up, you're gonna have like 5 majors that all want that deposit. Yeah, maybe that gets a huge premium. So again, going back to, like, if you're gonna explore, probably go for tier one assets. But also, if we don't find many more, or the M&A cycle starts to heat up, and there's a game of musical chairs where it's like, oh crap, there's not even that many tier 2 deposits around. So maybe there becomes some kind of a frenzy for tier 2 deposits, because the alternative is like, oh, we don't have any tier 1 deposits and no tier 2 deposits, so we're just going to slowly die as a mining company. That's not typically how companies operate. Oh yeah, we're okay. We didn't find any tier one or tier two deposits, and we're just gonna accept our fate. Yeah. Anyway, second Lassonde curve. Yeah, that's one I still think is very interesting, especially for gold and increasingly so for, I guess, silver. That's some of the silver juniors that have done well. The ones where it's like, pushing towards, small scale production and all that. But again, just keep in mind, um, what's two and a, let's say 3 million ounces of silver equivalent per year. 3 million ounces. What the hell? Divided by 90. That's 33.3 thousand ounces AU equivalent. Not many people would care too much about a gold junior that, let's say, had that kind of production, even though they, probably should. But it's like in silver, it's much more hot. It's much more hot because I know some gold developers or gold silver developers with a focus on gold who are kind of around that scale, and they're not nearly as hot as some silver junior. Why is that? Well, again, I think it's because uh, people really don't factor in the relative valuations, and the idea is that, well, silver is hot, and if silver goes up to 50 to $100, they go into production. Man, they're gonna print a lot of cash. Yes, if that happens and everything works out, that might be the case, but it still doesn't change that probably a equally sized gold junior or a million ounce or a 500,000 or a million ounce gold developer with low capex startup might make more than the silver junior unless silver goes to 45 plus. So that's still a head start, and and it's not nearly people are not nearly as excited about that. So yeah, again, just one thing to think about. It's like the sector is, it's the marginal investor that sets the prices in this space. So yes, again, if I just summarize so far, uh, gold versus silver juniors. Note that there's much more sentiment driving silver juniors. So if you're after that, if you want to, greater full trading strategy, aka which in reality usually ends up being some kind of pump and dump. Not for everyone, but I'm just saying that's like if the idea is that, well, they can get bid up a lot and that's your win condition in a sense, yes, that's greater full trading strategy. And I own some silver juniors too, so it's not like, oh, I'm just gonna stand on principle and not try to take any advantage of the fact that silver juniors can go up a lot, because it's like the least sophisticated investors have a tendency to buy them up when they feel like it and get greedy, and they can go up the most without um, coinciding increase in value. It's like, yeah, but I'm not gonna necessarily pretend like that's 50% of the case. Let's say maybe. I'm not gonna pretend there's like, no, it's just because of fundamentals. I mean, yeah, I hope you get what I'm saying. Yeah, so for exploration, I think it needs to be tier one. Otherwise, you can just buy tier two and tier three assets right now for less than it costs to actually prove them up. And yes, that's why I don't think the sector really makes sense, in the sense that if you look at the valuations of the tier two and tier three assets in gold, let's say, why would anybody go out exploring? The 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 odds of finding a tier one discovery is like so slim. I mean, it's a statistical anomaly to say the least. And yes, you can get super paid if it happens. Yes, But a tier 2 asset is still a tier 2 asset. And if you can buy that, let's say somebody pitches you, it's like, hey, we think we have a tier 2 discovery here on the property. It's going to cost us 200 million to prove it up. It's going to take 5 years to prove it up. On paper today, it's going to be worth $3 billion. Or sometime in the future, let's say. $3 billion. It's like, okay, yeah, I'm listening. But the thing is, if that happens, we spend 200 million, takes us 5 years, so you have to wait 5 years to prove up we have a tier 2 deposit, and the tier 2 deposit on paper, the project is going to be worth, let's say 2 billion then, 2 or 3 billion dollars. Hey, you can buy it for 100 million. Why on earth would I not just go and buy this thing selling for 100 million, then spend 200 million over 5 years to prove something, and the reward is a market cap of 100 million, less half of the investment I put in, and I had to wait 5 years for it. So I waited 5 years to have my investment get cut in half. At face value. Obviously, in reality, even if it's trading for $100 million, if it's worth $2 billion, I own something worth $2 billion. But the opportunity cost is I can buy something if there's stuff trading for 100 million that it would take 5 years and 200 million to prove up. I would be a fool really not to buy the bird in the hand for half what it costs to prove the bird in the hand, and it's worth 10 to 20x what I'm buying it for. It's just crazy. So in that case, yes, tier 2 explorations, like that's, typically fat target or whatever. If it's a really cheap junior, that's fine as well, because a tier 2 asset is worth a lot more than a lot of them are trading for. That's why, again, it's like my hodling is pretty chill. I mean, I haven't been asked to do a coping video in quite some time, and I don't feel stressed out at all. I mean, I see some people who made money in the major miners, the producers, some are saying this, like, yeah, I made my money in this cycle. And to me, it's like the junior cycle hasn't even started yet. Because they're selling dirt cheap. They're selling for, whatever, 10-20% of net asset value. It's like, why on earth would that be considered? Like, am I tempted to sell? That's, this is it. Like, no, I'm full on bullish. Oh, and also Fraser rankings. Finally, I don't know what took so long, but the Fraser rankings are finally out. Interestingly, and by the way, it's like, I mean, just take some of these, for example. I mean, Novo is a residual position nowadays. I mean, back in the day, it was, an idea of a with Waterstrand, I mean, basically beyond tier 1, that was the bet. And I am convinced that there's hundreds of millions of ounces down in the Pilbara, in the conglomerates. It's just that, okay, we have no idea how to economically mine them. So, a technical failure in that sense. Tokwan Ventures, I mean, that's a second part of the Lassonde curve player, gold, silver, Mexico, BlackRock, and this I wouldn't consider to be, again, like a typical silver trading sardine, because they have such high grades that's on paper right now, according to the PEA, that's a very, very robust system. Plus you get the added benefit, let's say, of, yes, people love silver. I mean, Eric Sprott is buying BlackRock silver hand over fist, for example. But that's still, what it looks to be a very, very robust high-grade silver gold story. So that's like an actual investment. That should be making a lot of money. That should be worth something. That should probably get put into production. So that's not something I consider as like, this is never going to become something, but it's sure as shit's going to see the least sophisticated juniors or junior investors buying it up. Hannon Metals, I mean, they have their Previsto like fat alkaline gold target, and I have a bunch of other stuff, and the management is great, but also like, tier 1 type of exploration stuff. K2 Gold, uh, yeah, it looks like they have they have a very juicy project in the US. So it's like the exploration stories needs to be really compelling for it to be worth it. Cobria, same thing there. Uh, their first, I don't even remember right now the flagship target they have, but it's like uh, judged by some to be one of the best porphyry targets still around and untested. Again, tier 1 potential. Arctic Minerals, Swedish story. I'm actually going to visit them probably or hopefully in 2 weeks, I think. Sediment hosted copper silver in Sweden. That's also one where it's like, hey, theoretically they can have 500 million tons or a billion plus tons at the end of the day. Tier 1 type discovery potential. But anyway, going back to the point here, top mining jurisdictions. Finland came out as number 1. I've heard some people, not necessarily agreeing with that, and that's fine. I mean, everybody's gonna have their own idea. I mean, I think one theme here is obviously is like a big shock for me was Norway getting into top 10. So it's like there's 3 Nordic countries in the top 10 in the world. I think, and I've been talking about, and I've said it's like I think Sweden is gonna make it to the top 10. I thought it had a shot of making it to the top 5, so I was one off. But that Sweden is considered now the 6th best jurisdiction in the world. And I know some thinks it's actually become better than Finland, but again, this is also a lagging ranking. I think Sweden, or just over the last 6 months, have done stuff like government forcing municipality of Kiruna to basically I think it's a graphite mine. It's like that's pretty much as pro-mining as it can get, the government overruling. And that's never happened before in Sweden. So I think I was going to go back to my point that I think this is EU basically forcing the Nordics to like, hey, you're going to be the countries that basically we're going to need the metals for the EU to be produced there. So get on it. And that's because otherwise, I mean, it's just crazy how much of a mining push that's happened recently. I mean, in Sweden, they're recording I think they're recording right now, or maybe haven't started yet, a reality show where they follow LKB, the state-owned miner, and Boliden, for example. It's like, why do you do that? I think that's a push. It's like, we gotta bring the sentiment around. We gotta get people pro-mining. Best way, make it accessible, make it cool, have a lot of people work in the mines, show that there's not cyanide spills all over the place and all that. And one other shocker, Western Australia fallen out of the top 10. Canada taking a hit. I mean, Sweden is ranked higher than any Canadian jurisdiction. That's pretty cool. I mean, I've said this a bunch of times. I talked to one guy who, I said, hey, you might want to take a look at First Nordic. I don't like to directly pitch anybody. It's like nowadays got to be a real good reason, because it always feels like, if I pitch something to someone, it's like, oh, please buy up the stock because I'm already positioned. That's how it feels like. So it's very, very uncomfortable. I have no problem talking about it, and then people, can make up their own mind. But just directly pitching someone that I mean, I obviously do that with friends, for example. Who knows? I am not looking to. I'm not looking for them to be my exit liquidity, if you know what I mean. But yeah. So it's like some people when they see Sweden, for example, it's like, no, forget it. It's like Sweden, black box. They have no idea. They don't know anything about Sweden. It sounds exotic. They don't have any juniors probably that are in Sweden. They've never invested in a project in Sweden, so that just makes it a lot, scary, and that comes obviously with a discount. If we are to believe the Fraser rankings, Sweden should have a premium and should have a higher premium than any Canadian jurisdiction. Would I say that's the case with First Nordic? Absolutely not. I think they're being discounted, and that's one of many reasons why I think it's so cheap. It's being discounted for being in Sweden, even though it's officially now at sixth best jurisdiction in the world. Some other stuff. Study with over 70k people found those who obsess about being the best have much worse outcomes than those who are focused on being the best at getting better and who define success on their own terms. All is relative, and that's in my opinion, this is incredibly relevant to investing. Personally, I think that, we know statistically, 1 in 20 outperform an index of active investors. And I think 10% of active funds outperform, the market, etc., etc. So very small percentage. And I honestly, you can kind of tell. As soon as you post something, it's like, this looks cheap or whatever, and somebody says, I think it can get cheaper, or everybody's kind of a market timer. Everybody wants the perfect trade. And that's why, I've been in many situations, for example, where it's like, I think something is really cheap, and then it gets cheaper. And maybe before it bottoms, I'm going to be down 40% on my first buy. I just average down in those situations if the case is intact and all of that. And I'm convinced that, no, it's just something gets cheaper. So I think I'm going to make money, let's say, on my initial buy, and I'm going to make a lot more money on, the last buy, let's say, before it bottoms out and it's down 40%. Because if the story is unchanged, it just means a heck of a lot more upside is going to come one day. But a lot of, again, people can't stand that stuff. They hate catching falling knives, yada, yada, yada. They never want to feel like they buy something and it goes down in price. And also one of those cases where, when you have that kind of a experience, then you also becomes like, I've been kicked in the teeth so many times. I started buying too early, so I'm gonna have a stink bid. A lot of people stink bid, and if you get stink bids in, that's great. And sometimes it actually, sometimes, in a sense, it makes sense, because if you like a story at price X, and if it gets cheaper, you would like it more if you're a value investor, because that means more upside, better risk reward. So in a idealistic scenario, one would have infinite stink bids in a sense, because if you think something is worth a 5% position at price X, it's just really, really cheap. The lower it goes, the better risk reward becomes. So 5%, if it goes down 10%, let's say you should add so much that you have a 6% instead of 5%. If it goes down lower, you should ramp it up to maybe 8% all of a sudden, yada, yada, yada. So from that perspective, it does make sense if you have that kind of value investing approach. If cheap gets cheaper, all else equal, you would want a higher position, because the risk reward just gets better, right? More upside, less downside, yada, yada. Or same risk, more upside. But a lot of the cases, also what I think happens is, you find something, you think, oh, this is really, really cheap, and I should be buying more here. It's this is really cheap, but you're like, I think it can get cheaper. So let's say you don't even have a position yet, but you're like, I want the perfect buy. I think it can go down a bit more. I want the perfect buy because I don't want to buy it at 50 cents and then it goes down to 46 cents. That's just going to feel terrible because then I've taken a paper loss and I could have bought it at 46 cents or 45 cents. And often it's like, in my opinion, that's kind of a lot of cases that's too greedy because in my version it's like if something is bastardly cheap at 50 cents, it's greedy to be putting in just a stink bid, not buying it, putting in a stink bid because you think there's a few cents more downside. So you're looking for the perfect entry basically. And some people are very good at, let's say, stink bidding and yada yada yada. But I think typically I think they're more swing traders in a sense because let's say face it, if you think a story has like take Magna Mining for example, if you think well, I mean their vision is to be a 3 to 5 mine producer in 3 to 5 years, and you think it's like, oh man, if that happens, it's gonna be worth whatever 5x in 3 years, 10x in 5 years. Let's say could be more, could be less, but let's say that's the outlook you have. That's your guesstimate. That's your base case. That's an incredibly good return over 3 years and over 5 years. Should you, let's say it's trading at $1.8, should you stubbornly sit and it's like, I think there's some downside here. I'm gonna put in a bid at 170 or 160, hoping it goes down there. What if it doesn't go down there? What if you're sitting there waiting for your stink bids, all of a sudden it's at $2. 1 week later it's at 2.2. Maybe you're not gonna buy it. Maybe you find something else that's cheaper, sure. But the idea is, or my point is, in that case, you kind of pissed away a 3xer case in 3 years and or 5x or whatever I said, and a 10x in 5 years, just because it wasn't cheap enough. You thought you could get a 6x in 3 years and a 12x in 5 years. A 10x in 5 years is like, that's more than a great case. That's a compounding that's really really good, right? Yeah, so my point is that like I think actually this the search for perfection, and the funny thing is like I think the people with the worst track record, they are the ones that are the biggest perfectionists. They are the ones who refuse to buy lower because they think there's always more downside, and they do not want to buy and look stupid. They want to buy when the coast is clear, when it's like the next move for sure is going to be up because sentiment is turning around, everybody's talking about higher prices, and it's like this time if I buy now I'm probably not going to lose money. Waiting for the trend to be your friend and all that. And yes, some people make money doing that. But my point is like when the trend is your friend and it feels good to be long, every single bottom buy is probably well in the money at that point in time. So where you make, the latecomer makes 50%, you might be up 150. So I do think, and that's why I post now and then or tweets like, forget about having the best performing portfolio. That's probably why people are not making any money. They're obsessed about having the best possible returns. It's like, ooh, I'm gonna try for like 300% over the next 6 months. So they're constantly thinking about that, having outrageous return goals. And the cost is usually that you lose money instead. Instead of like, hey, okay, I'm not going to have the best performing portfolio, but if I pick these 20 names or whatever, I'm pretty sure I'm going to do really well. I'm pretty sure I'm going to beat the index. I'm pretty sure I'm gonna be up, let's say 100 to 200% over the next 3 years. And that's not good enough for people because they think they can do that in whatever 6 months or something. And then they end up buying the hot sectors, the hot stocks that are working right now, because they've seen that they have gone up 100% in a week or a month, and they think, well, if it keeps doing that, then I'm gonna have my 300% over 6 months. And instead, it might be a short-term top they bought, goes down 40% in 2 weeks, and instead of being up 300% in 6 months, all of a sudden they almost cut themselves in half. So now they have to make 500% from here to get that 200 to 300% return, etc. Think about it. I think honestly, I think that's probably the biggest mistake, the most obvious mentality that leads people astray and buy high and sell low. Everybody's almost everybody's way too greedy. Okay, another one. China is choking supply of critical minerals to Western defense companies. Maintaining controls are a sign of leverage. Again, going back to, here I can start pissing on Bitcoin for a while. What's strategic about Bitcoin? Absolutely nothing. If you had 5 countries at a round table, one country owned all the Bitcoin, one country owned all the coal, one country owned all the food, one country owned all the copper, one country owned all the gold or silver, for example. Even gold in that sense is like, yeah, when the chips are down, you can't eat gold. It's a good conductor and all that. But coal is even more important, right? If it really comes down to it. So the Bitcoins, like, who needs Bitcoin out of those parties? If the country has all the Bitcoins, what's their leverage? None of the other countries need Bitcoin. Right? I hope you get what I mean. It's like copper is needed to have modern civilization. Coal is needed to heat your house in some places. Lead is needed to, have a war. If you don't have any lead or whatever is needed to make tanks and bullets and yada yada, well, you're shit out of luck. You can't arm yourself, and somebody who has that and can arm themselves, they can take you over, and you can do nothing except try to throw sharp sticks at them. There's like strategic, this kind of stuff is strategic. All of a sudden it's like, oh, we're missing one critical mineral to make our Tomahawk missiles or tanks or whatever. Okay, shit, we can't make the tanks. Or if we can make them, not going to be nearly as good. That's a huge problem. If you have Bitcoin or not, who gives a shit? Right? It's not critical for anything. But it's like, yeah, when the ships go down, why am I comfortable with commodities? Because all of the S&P, all of the Nasdaq, even Bitcoin, every crypto needs metals and commodities. This is the foundation of every single company that's not a mining company. It's the mining companies that are the common denominator. If robots take over, if AI takes over, well, okay, let's say they make everything super efficient. Well, what are the robots going to be made of? They're not going to be made out of Bitcoin or air. They're going to be made out of metals and minerals. And they're going to probably produce stuff that's, from metals and minerals. So wherever way we're going, commodities are going to be needed unless we, solve, alchemy basically, or whatever. yeah, until something very drastic happens. If you don't have the commodities, you don't have anything. So I don't know where AI is gonna go. I don't know what war is gonna happen, or who's gonna win, or what the next big tech company is gonna be, or anything. I just know that unless something, you know, happens for the first time ever, that's like we solve that we don't need commodities really. Well, commodities are gonna be needed. Maybe, yeah, check up on the. Now it's not been updated in about a month. I think it's kind of similar. Again, I haven't done much in the again HODL folios. Like, yeah, Magna Mining long term case, First Nordic super cheap long term case, just to actually become, I mean, objectively higher value, because now their flagship asset is in the sixth best jurisdiction in the world officially, and their second project is in the best jurisdiction in the world officially. Um, Better than all Canadian jurisdictions, and it sure as shit is not pricing that in, or reflecting that, I was gonna say. Home run. Also, and note is like Magna has done well though, but it's like Home Run and First Nordic, they are some of the top five biggest positions. I think First Nordic is the biggest position in every HODL folio, and that's at a multi-month low. So that's uh, been an anchor in a sense. And of course, it's not like I'm not selling First Nordic because it has gone down. If anything, it's like I'm more inclined to up the weighting because it hasn't gone up in price. Integra again, it's like, yeah, second less on curve, cash flow, or yada yada, treated like they don't have the two other projects. Amex Exploration, like, probably, yeah, tier 2 asset. I think that's going to be bought or put into production. Goliath could be a tier 1 discovery. And I especially think that they're going to keep on, if it's not a tier 1, they're still going to keep hitting stuff. Third, the Pasco. I guess that becomes a bit harder with the news out of China. I think they have some gallium and stuff like that, but a large silver project, good management, silver and gold, high grade silver and gold, Mawson. Yeah, I mean that's probably a tier 1 discovery actually, done really well. I mean, they have like what 8 rigs or something. That's probably gonna get acquired one day or put into production. District Metal, that's the hardest one to value. Uh, yeah, I mean an infinity deposit, basically Inflection Resources. Still waiting for a drill update. They have more ground now. Snowline, yeah, that's a world-class deposit. They own a small country, basically. Probably gonna make more discoveries. Hannon Metals, still a high risk, high reward play. They got a lot of targets. Rakla Metals is the newest member. Uh, it's high risk, high reward. I mean, at face value, it is, or it really should be considered. I just think it has actually a shot of being a tier 1 discovery, but I'm not betting the whole portfolio on that. It's just that it's large enough position that if that gets erased, it's gonna suck, but it's not gonna kill the portfolio. If that turns out to be an exceptional discovery, if it turns out to be that they're onto a valid type discovery or even better, that can go up a lot just in the next few months actually. And they're not going to prove out blue sky in the next few months though. But yeah, it's simply one of those high risk, high reward cases, and if the high reward ends up being true, it can get reflected quickly. And this is the performance of one of the HODL folios. uh, it's not a miracle return. It's not like, you see people on Twitter, it's like, yeah, I'm up 100% every year or 200% every year. No, but it's doing its job. It's like it's not active trading. It's not pump and dumping. It's not getting in and out of positions. Like most of the top five vary a bit. Either I find something that's even cheaper, or something goes up in price and surpasses something else. I mean, the HODL portfolio hasn't changed that, or doesn't change that much on a month to month basis. And for example, now, okay, it's, I mean, around an all-time high, I guess. Um, but that's with the, largest position First Nordic going the opposite way since February, basically. And home run is around the multi-month lows as well. So you have, two very large positions, or two large position basically gone down, and it's still at least at all-time high. And I think, I mean, if I had to bet, I wouldn't be surprised if First Nordic and home run might be the outperformers in H2 this year. Why? Because they might be the two that have the most catch up to do. And maybe some of the other ones are gonna like not do that well. But at the end of the day, if I own 30 cheap names, if I do nothing, I expect this portfolio to go higher. I think the portfolio was cheap here, I think it was cheap there. That didn't stop it from going like that, but it also didn't stop it from going like this. So it's like, hey, I'm pretty okay of if I can just, without much active management, if I can have some family members outperform the GDXJ even in a junior bear market. I mean, well, this we're not in a bear market now. I think we bottomed in sometime in 2024, and it's up from then, obviously. But when the junior bear market, that started like what, 2020 or 2021? I think the average junior is probably still down 70% from whatever the sentiment peak in juniors was, and the portfolio is at least up from that peak. But this, again, this is not something that these returns are not something where it's like it's gonna look splashy on Twitter, for example. But I sure as shit am pretty happy with being able to have some outperformance for family members, etc., without active trading, and no placements, no warrants, and all that, no timing really. Yeah, and then I just had some. I mean, yeah, Sonora Gold is also one of those second part of the Lassonde curve, and this one is kind of interesting in the sense that it's very low capex project. They haven't gotten the permits yet, but very low capex project, gold and silver. Not high grades and all that, but really simple operation. But it's like, if you convert this to a silver story, it probably would be a lot harder. Even though it's like, if you had the same economics, but if it was like Sonora Silver Corp, I think it would be much harder. And that's just a function of how market participant psychology is, but doesn't necessarily make sense. Not really. Headwater Gold. This is one. I mean, there hasn't been that much news lately. I mean, we're still waiting for drill results all over the place. But that's gonna kick off soon, and that's something that might get the market going again. And actually, it's like when I think about Rackla, for example, since they have such a unusual target, if they hit, uh, if that ends up, if we're lucky enough that that's actually a you know, world-class kind of discovery, that might get fun, and that might also again increase the sentiment on the entire sector. Not a guarantee, certainly not a guarantee they're gonna find something that's Snowline Valley type discovery or better. But hey, there's a possibility at least. Um, and maybe we need a success story like that to get going. But I also think that goes to show how hard it is to find a really, really great, tier one type discovery nowadays that actually gets bid up. Because if you find a tier two, yeah, market might not care that much, even though tier two is tier two. Yeah. But yeah, so they signed a letter of intent with Oceana Gold to explore 3 projects. Very juicy deals, like funded all the way up to PFS. If things go well and they keep a 25% interest, fully carried up to PFS and including a PFS plus a royalty. Um, that can be a material, for their market cap. So they have 2 projects earnings with Newmont, and it looks like they're gonna have 3 more with Oceana Gold. So that's five kicks at a can that Headwater doesn't need to fund. So this is a case where it's like, theoretically they don't need to do another race and will still explore 5 targets. So basically, there's no, for some juniors, and that's the problem, I guess, with this sector, is like, when a stock gets cheaper or lower in price, that is not necessarily that it's by default just getting cheaper, because there's the dilution effect and the sentiment effect. That a lower price gonna get people like disenfranchised with a story, and they might be more likely to sell it even though nothing has changed. And then a placement comes out and it's like, oh, it's more dilution than 4 months ago, and that's gonna get people to be disenfranchised. Plus, it literally means that there's more dilution, so you shave off some of the upside for let's say long-term holders. So there's not a direct line where it's like, oh, if it goes down in price, it's 100% just cheaper. No, there is spillover effects from dilution, etc. And the risk of getting trapped in kind of a dilution spiral. I think we're past the bear market, so I don't think we're at that much of a risk for the average serious junior. But in the case of Headwater, if you're fully carried on 5 projects, you don't need to raise really, unless you want to, and you don't want to raise cheap, so you might not raise if it's actually cheap. Then there's no dilution spiral, and yeah, so if that goes down in price, it's just straight up cheaper, just straight up a better buy in that case, which is kind of nice actually. It's like, yeah, again, it's like, oh, there's no threat of being put or kept in a dilution spiral, for example. That's something worth thinking about, I think. And the flip side, of course, funnily enough, that a junior which is needs dilution, which is like vast majority of juniors, a rise in price at least has that effect of at a higher price means less dilution to get a X amount of dollars in the bank, plus it's easier to get money to produce news if it goes up, because there's probably going to be better sentiment and more people willing to throw money at it. So that's the main reason why this sector is so goddamn volatile. And in the bear market, stuff can go down 80%, but when it flips, stuff can go up hundreds of percent as well. Because you have the dilution spiral and sentiment spiral on the way down, and on the way up, you have decreasing sometimes dilution, all else equal, and more access to capital, which means more news to be able. I mean, if you can drill 20,000 meters instead of 5,000 meters, obviously you can produce even more value, right? If you have a legitimate discovery, you will de-risk it more with 20,000 meters of drilling than 5,000 meters. So more news releases, more value created, gets people going. If you get rewarded for the success, higher price, which means less dilution and maybe even more capital, so you can have a 30,000 drill campaign next time around. Whereas again, on the flip side, in the bear market, decreasing access to capital, increasing dilution, and decreasing, especially if management has skin in the game, decreasing appetite to raise a lot of money to try and produce a lot of news, which bores people, and then it goes even lower. That's, I think, there you have basically the main reason why this sector absolutely gets slaughtered and then can rally like crazy coming out from a bottom. Because it has really the negative spirals and positive spirals, and they start off from extremes. So when the bear market bottoms and the positive spiral starts happening, you go from extreme low valuations, plenty of upside, and then you have a positive spiral on top of that. And when you go from a euphoric top, let's say, you have overvaluation, and then you have increasing dilution, decreasing news flow, decreasing share price, decreasing appetite and access to capital. Yeah, anyway. As always, this become a long-winded video, and I didn't really go into depth with any particular company. But I as always, I think it's, the mentality, the strategy, sticking to your guns, sticking to a goddamn strategy, and, for example, not trying to have the absolute best best results possible. I mean, if you're aiming to have the best possible portfolio on Twitter, the amount of risk you probably need to be taking is probably gonna, lead you straight to the poorhouse. That's why so far, I don't think I've ever participated in the CEO stock picking contest. I mean, it's like I'm probably not gonna win anyway. B, if I really want to try and win, I have to go for. I mean, it's like the law of large numbers. If you have if you have 1,000 people entering a contest, and to win, you need to outperform 999 people. So all your 3 picks need to go up 5 to 10x, let's say, to take the number 1 spot and win the contest. What's the risk how likely are you to pick 3 10-baggers out of 3? I know a lot of juniors that could certainly become 10-baggers. So if let's say I picked Rattler right now, and let's say I picked Westward Gold, and I picked Inflection. I like all those exploration stories. But if those are my top 3 stock picks for the context, they are not yes, if you only had 3 stocks you could invest in, you should pick Rattler, Inflection, and Westward, for example. No, I don't think so. If you only had 3 companies, you shouldn't be in 3 high risk, high reward juniors. Because they might all miss. And then you've blown out your entire portfolio in time for the next massive, I think, bull market. So I don't even want to get people the idea that, I mean, again, if I want to legitimately compete in the contest, I have to have a shot at winning. I have to pick real high risk juniors, the ones that, if again, high risk, low chance of massive success, but if success happens, they can go up a lot. Why? Because they are, let's say, typically long shots, and I need to be lucky on 3 out of 3 to win the contest. Then I guess I could simply just do it where it's like, oh, I'm gonna try to pick my 3 favorites from a risk reward perspective, and emphasis on the margin of safety in case somebody gets the idea that those are my top 3 actual favorite juniors in a vacuum. Yeah, well then I'm never gonna win the contest. Because let's say let's say you have your favorite risk reward cases, like I think it's gonna I'm almost positive it's gonna go up 200% in 2 years. That's a absolute phenomenal return. Absolute phenomenal. If you could find 200% returners every 2 year, again, after not too long, you're gonna be rich as Buffett, right? But that's still not gonna win me the contest. There's no way 1,000 people can pick 3,000 juniors, or I mean, yeah, they're not gonna be unique picks, but you get my point. Somebody is gonna take 3 high risk, high reward stories, and somebody's gonna get lucky on 2 out of 3 or 3 out of 3 and win. And the second is gonna do the same, but maybe not as high returns, maybe had almost the same stories, but one was off. So in that case, there's no point really, because if I try to win the contest, I might have people thinking that those are my top 3 favorite picks, which I own the most amount of, most of my portfolio in. But if I pick the whatever, like my favorite risk reward cases, then there's no chance I'm gonna win the contest or even get close to winning the contest typically. So I'd rather just discuss in videos like this, etc. and where there's context. It's like when people ask me what are your favorite juniors. Like there's no point in me telling you what my favorite juniors, or when people's like, what should I be buying? Like I have no idea what you should be buying. I don't know your mentality. I don't know your holding period. I don't know your appetite for risk. I don't know how your portfolio looks otherwise. I don't know how your net worth, your total investment capital looks like. Only you can. Again, that's why it's like nobody. I can't tell you what you should invest in or how much you should invest in anything. That's why I say how I look at things. Again, how I look at things, what suits me, what risk I see, what I think about risk, what I think about the upside, how I think about you need enough high risk, high reward stories. You can if yeah, I'm getting tired, as you probably can tell. Tomorrow I'm actually leaving for Finland. I'm gonna go a site visit to Finex Metals, which is also that would be one where it's like if they hit on that, could get really fun. But I don't know it's gonna hit. It's not I'm betting the farm on it. But for a pre-real discovery junior, I have a pretty big position for a pre-discovery junior. But some of the low risk ones, they're much larger positions typically. So nobody can tell you what you should do. Again, if I give you my absolute favorite case and tell it's like you should be buying this, if you have no idea why you own it, why you should own it. If you have no conviction yourself, what do you think is going to happen, uh, even if it is intact and it is in fact the best story around? It's like you'll make more money having high conviction in what you perceive as good stories, and they are good stories, than you'll make in being in great stories with no conviction. Because you have no idea what you're looking for. You're probably gonna panic at if you start buying a great case, it goes down 30%, you have no conviction, you're probably gonna sell out. Vice versa, you're probably gonna be chasing everything higher. Why? Because you didn't think it was cheap when it was a price X, but after it's up 30%, all of a sudden you start to think it's a great case or a good case because some other people bought it up. But that return has already happened. Yeah, that's I guess my point. I mean, without conviction, you're basically toast. And that goes for just conviction about the cyclicality of the sector. I know people who basically threw in the towel maybe last year, maybe 4 or 5 months ago, and bet on Bitcoin and MicroStrategy and what have you. And some of the stuff they sold is probably up 100% since then, and Bitcoin is not up 100% since then. And that is a feeling I don't want anybody to have, because that's when you haven't broken the cycle. You ended up selling something, even a cyclical sector, at its maybe cheapest prices anybody has ever seen in 40 years, to buy something that is hot, that is high, and probably has, well, yeah, almost by definition has like much worse risk reward. That is such a sucky feeling. Imagine if you sit in you bought into juniors at the high on 2020. You ride them down, refuse to average down, regardless of how cheap they got. I thought they started to get cheap in 2022. Was that a bottom? No. I thought they became cheaper in 2023. Was that a bottom? No. 2024? Yes, that ended up being the bottom. And I averaged down throughout those years. Just kept on buying, kept on buying, kept on buying, kept on average looking wrong, kept on, it looked on average even more wrong the next year. And then finally 2024, bottom comes in, start to look less stupid, start to look less stupid, yada yada. But compare that to somebody who bought the 2020 high, maybe averaged down the first year, maybe second year. Then in 2024, when every single buy is probably at a loss, or most of them are at a loss, your portfolio is down 50%. So your return in the market, in the juniors, let's say it's minus 50% over the last 4 years. So you spent 4 years waiting for a reward that is minus 50. And then you sell at the most no-brainer buy levels anybody has even seen in 40 years. Then you buy Bitcoin, for example. Let's say Bitcoin doesn't do much. Let's say it's up 10-15%. So you clawed some of the losses back from your paper loss of 50% that you cemented to a real loss when you got out and bought something, and that's up 10-15%. You still would need 100% to break even. But in the meantime, the juniors did bottom. Sentiment had reached a low, turned up, and that portfolio, your portfolio might be plus minus zero now. and the sector is still cheap, and you would have followed the story, so you know what's still cheap. Hopefully you would have learned a lot about juniors. Hopefully you would have researched companies all the way through that. So it's like, I mean, for example, I think my portfolio might be the cheapest ever still, in a sense. Or maybe it's not as cheap as 2024. Maybe not. Who knows? My point is, I think there is a lot of room still to go. I mean, when I just look at some of these names, again, Magna is like, they have one mine, they're hoping to get to 3 to 5. Obviously, that's a lot of runway left. First Nordic, probably cheapest it's ever been, and now their assets are officially in the number 1 and number 6 jurisdiction in the world. That's great. That's the, I mean, yeah, I don't know what Finland was at. I think Sweden was like 18 or something. So at face value, massive value increase. Their tier 1 asset jumped up to being in the 6th best jurisdiction. Their second asset, which could become a tier 2 asset one day, is currently in the first one. And that's like Integra, forget about it. It's like they're investing in the mine today. I mean, if they get 3 projects up and running, it's not even going to get close to this valuation. Amex, yes, that has actually revalued a bit, so I don't think it is as cheap as it was, 40% lower, because gold price hasn't gone up that much. But still, I mean, on paper, the new PEA isn't out yet, I'm pretty sure, but heck, on paper, at these gold prices, Perron might be worth what, like $2 billion or something on paper, 1.6 at least. They're at a 200 million market cap. Is there some room left to the upside, or is this it? If this portfolio was like plus minus zero after being down, no. And let's say fast forward a year, let's say the portfolio is up 100%. Okay, that's great. It's doubled. Let's say it took, what would it be, 5-6 years? Yeah, 100%, not super great after that amount of time. But again, almost every one of these, I think, has for sure more than 100% upside without like asking too much. Multi-bagger potential, multi-bagger potential, multi-bagger potential, multi-bagger potential, multi-bagger potential. Yeah, I would say it still has multi-bagger potential, especially if it becomes a tier 1 discovery. Probably multi-bagger potential, multi-bagger potential, multi-bagger potential. Mawson, a double, I think. I mean, I think it's going to get acquired, so maybe not like multi-bagger potential. It could happen if we go into a harder sentiment environment, because their project could be worth, a few billions, I think. So on paper, multi-bagger potential, big wild card. Inflection, for sure, multi-bagger potential. Snowline, yeah, I would still, I mean, I think it could, could actually double without actually getting a lot more in terms of, exploration success. Multi-bagger potential, multi-bagger potential. I think this portfolio, for example, if I do nothing, I think that's going to go up more than 100%. And it doesn't require that much time. And if we're thinking blue sky here, let's fast forward 3 to 5 years. Let's say this is trading at 2 billion. Let's say this is trading at 1 to 2 billion. Let's say this is trading at a billion. Let's say this is trading at 1.5 billion. Let's say this is trading at 800 million. Let's say this is trading at 1.5 billion. Let's say, So like I think there's plenty of potential left, and obviously it's not like I'm saying that these are the only ones. I mean, I don't expect. I'm probably not. I might not have any of the absolute highest performing juniors in the over the next 3 to 5 years. But again, that's okay. I'm not after. I don't need the best performing portfolio. I don't need perfection. If I average whatever, pick a number. If you would average 30% per year over the next 10 years, that would be an absolutely phenomenal return. But that's not going to be, again, that's not enough for most people, especially the people that have had poor performing, poor returns. The poorer returns, the more risk you take, the more you need to make it back. And that's why, yeah. No, it's just, that's just how it is. That's how humans work. And I mean, that's why most people go bust in poker. They have a losing streak, uh, and mentally it feels so shitty that you're, let's say you have less money than you had like 2 months ago or a week ago sometimes, and that's enough. And then you start to jump up in stakes because you want to make it back even quicker. When you have less money, you take more risks. So you jump up in stakes when you should probably go down in stakes. But what does that mean? It's probably going to take even longer to get back to where you were. So if it took you 2 months to lose in poker, let's say lose 50% of your bankroll, and you go down in stakes, it might take you 4 months in your head to get back to even. That's just too much to bear for most people. So instead, you try to take a shortcut. If it took me 2 months to cut it in half, if I jump up in stakes, I can make it back in 1 month. That sounds better than taking 4 months, right? To start earning net money again, to get a new high. Yeah, so that's about it. And that's why, again, the worse your returns have been, usually the worse you start investing. And it's very human. It's very human. The trick is we don't really want to be in that position to begin with, right? And to be fair, if you down minus 50% going into a junior low, I mean like a major low, that's not even a problem. Stuff bounces like 100% is just a first taste basically. I'm pretty sure there's stuff out there in the junior sector that's probably up 300-400% from the bottom tick of 2024, which is kind of case in point. 100% is nothing, and I still think we're early. So you can imagine what some of those juniors might end up, how much they might end up being up from the 2024 low if we go into a major high in 3 years in the junior space, for example. I think some of them might be up like thousands of percent. And then the question is, how big of a deal is minus 50 really? If you're minus 50 into a cyclical top, yeah, that's hard to do, right? It's like if you lost money from the bottom in 2015 to the top in 8 months later, if you had lost money over that time, that requires some skill or some absolute bonkers risk taking. Anyway, I talked so long now. I gotta go to sleep. Thanks for listening. I hope you get something out of this. And yeah, closing words would just simply be, it's like, don't be in a rush. Focus on getting solid returns. Focus on trying to get solid returns over the next few years. Don't chase or don't focus on getting the absolute best returns over the next month or the next 6 months. It sure be, I mean, making sure you get solid returns or doing everything you can to put your in a position of getting solid returns instead of like a Hail Mary obscene risk or obscene over trading just to try and have the best performing portfolio. That's one way to piss away a great opportunity as well. Now you don't even need to take you don't need to take a lot of risk to have, in my opinion, high expected future returns. When this sector is overvalued, And the only way to actually, you know, there's nothing cheap to buy. It's like the next obvious move is down. Yeah, then we can talk about, alpha risk, whatever. If ounces in the ground are selling for $400, yeah, you might, bet on a 10 million market cap story that hopefully will find 1 million ounces and trade at 400 million. But now you can buy, that stuff for way less than it costs. Anyway, thanks for listening. Consider me biased. Assume I own shares of all companies mentioned. Some are banner sponsors as well, twice biased. This is not a buying recommendation. Assume I might buy or sell shares of any stock I mentioned at any point in time. So basically, for your sake, assume uh, uh, um, for your sake, assume I might be pump and dumping. That's probably the best way to put it. So it's like, don't do your own due diligence, make up your own mind. Don't like leave everything to me. It's like, well, you said positive things about this company, so I'm just gonna buy that without even thinking. No, don't buy anything if you don't understand why you would want to own it, how long you might need to hold it, knowing what you would do if price just went down, knowing what you would do if price just went up without value happening. Play the tape forward. How will you react in whatever story if volatility hits? If you know a store really well, you think you know more than the market, you're gonna say thanks sucker and buy more. If you don't know why you own it, price goes down, you're probably gonna be the one selling to someone else who actually has high conviction, and that person might be the same person who then sells you the same stock after it's up 100%, because now all of a sudden you get conviction, or rather you get greedy because now somebody else is buying it up, and that might be the guy selling it after he bought the low. So yeah, you're responsible for your money. Not buying or sell recommendation. I don't share your losses or your profits. You know the drill. Just keep a cool head. It's a marathon. It's a marathon. The only thing that matters is the long-term returns on your entire portfolio. Not what any particular stock is gonna do. And certainly you can have shittiest August in the world and you can still make a lot of money long term. And you could have the best possible August and you can lose money over the next 3 years potentially. It's like you don't know. Just put yourself just have a strategy that makes sense. Know what the win condition is. That's important. Why should you make money on a strategy and on a stock? Yeah. Thanks for listening. Bye now.